Hi, my name is Rashmitha, and through this video, I'll be talking about rising inflation and how it is affecting India's economic growth and the entire recovery process. Well, as India slowly emerged from the COVID-19 pandemic, we're hit again by the second wave, and although things could go south again, we're slightly better positioned than we were a year ago. But one of the key issues that could prove to be a hindrance to our recovery would be rising inflation, whose expectations have resulted in a slow uptick in borrowing costs for both the government and the private sector alike. While these are still early days to decide anything, the next year is going to be very crucial in determining how India's inflation trajectory progresses. Now, last year, as the pandemic progressed, the government had been very careful in the fiscal support that it provided to the economy, which was on the verge of crippling. But most of the 20 lakh crore stimulus package that it had announced in May 2020 last year was mostly in the form of food support and credit guarantees. And the result was a manageable 9.5% fiscal deficit for that particular year. While the rest of 2020 went by without any major disruptions, it was that additional borrowing requirements announced in the union budget that caught the market by surprise. It included an additional rupees 80,000 crore in borrowing for February and March. Now, this sent a 10-year Government of India bond from 6% to 6.2%, raising the entire cost of capital. Particularly in two bond auctions post the budget, the RBI had to intervene. It had to step in to keep bond yields from moving even further higher. Now, while our government is mostly looking at normalization of consumption, GST collections have been heading north and core inflation still remains very high. And global commodity, energy, and food prices have also started to move up, and short term supply chain disruptions can easily lead to price increase because of this. Now, India did rebound back into positive growth in the latest 3 months of the December 2020 quarter with a 4.4% rise in the pace of growth, but it was still much lower than the 3.3% that we had seen a year earlier than that. Now, Indian policymakers also have to contend with an economy where the terms of trade and the entire focus has moved to the rural economy because that's where the true potential lies. And if boosted and tapped into correctly, can prove to be long lasting and extremely beneficial both ways. Lastly, communication and power prices should move up in 2020. Now, all of this mostly because once inflation seeps into the system, once uncontrollable inflation seeps into the system, arresting it can prove to be very, very challenging, and there would be very little left in our hands. And because the last episode saw inflation rise in 2007 and loosening of money supply in the aftermath of the Lehman crisis, where bank credit continued to expand at 20%. Now, this was also a time when projects were stuck and money couldn't be put into productive use. The end result was just too much money chasing too few goods and services, and bad debts rising in the entire banking system. This, coupled with high imports back then, led to an extremely high pressure on rupee. But as of now, the central bank is mandated to keep inflation within 2% band of 4%. But already yields on 15% government securities have moved to 6.7%. That is more reflective of the current market. And lastly, the two additional factors that could point to yields moving north. The first one is corporate credit, which has been stagnant for the last 6 years. This could start seeing fresh demand as companies are starting to look at restarting capital spending again. Now, corporate credit has grown at 6.7% compared to a very high range of 20 to 22% in the earlier part of the decade. This is a major difference that we need to catch up on. Second is the normalization of liquidity. With all of this put together, for now, policymakers will be keeping a close watch on inflation because if it proves to be extremely sticky, the rising cost of capital for the government, companies, and individuals alike could slow down the entire economic recovery process, prove to be very expensive, while at the same time restrict spending on infrastructure, specifically areas such as infrastructure, and slow down the entire private sector capex cycle. Thank you.